The number of residential interest-only mortgages have dropped by nearly 3/4 over the last 10 years to just 8% of them being interest-only. But with the buy-to-let mortgage market, the majority are still interest-only. In this video, I'm going to explain what interest-only mortgages are and what you need to think about when considering if you should or shouldn't get one. So what is an interest-only mortgage? With an interest-only mortgage, all you pay each month is the interest on the amount you've borrowed. You don't have to pay the full amount back until the mortgage term has ended. This differs to repayment mortgages, where you pay back both the interest and some of the loan each month, which steadily reduces the debt until it's fully paid off by the end of the mortgage term. So why would you get an interest-only mortgage? Well, the main benefit is your monthly payments are lower, as you're never actually paying down the debt. You're just paying the interest. So in the case of a residential mortgage, for instance, it might make buying or keeping a home more affordable, as your monthly payments are going to be less, or even mean you can afford to buy a more expensive home. In the case of buy-to-let mortgages, it means you have more money left over after the rent you charge to invest in even more properties or take the rest as income. The disadvantages of interest-only mortgages are that when the mortgage ends, you still owe 100% of the money you borrowed, and so you are reliant on either being able to get a new mortgage or relying on selling the property or finding the money from elsewhere to pay back that mortgage. As long as you plan for this, it isn't a problem. For a buy-to-let investor, you're counting on the property prices rising. So if property prices double over 10 or 20 years, all that value created above and beyond the debt is profit. So you could sell off a portion of your properties to pay off the debt left on the others when you reach retirement, for example, or sell them all to bag a big profit. But if you have an interest-only mortgage on your home till you plan to retire, you're then going to need to either have a way to pay off that mortgage, or you're going to have to sell your home and hope that you've got enough equity left over to buy something else for cash. In conclusion, interest-only mortgages are extremely common and beneficial to the buy-to-let investor, but when buying your home, you're usually better focusing on a repayment mortgage. Now, that doesn't mean you can't hop and change between interest-only and repayment mortgages. With the cost of living crisis, a lot of people have been temporarily switching to interest-only mortgages to cope with the rising costs, which further underlines why repayment mortgages tend to be ideal for homeowners, as it just offers you that wiggle room as time goes on to absorb any unforeseen issues like house prices dropping or interest rates going up, or perhaps your career's being cut short for some reason. If COVID has taught us anything, it is that the unexpected is almost certainly going to happen at some point in the future. See you in the next video.